A strategy is where basically I'm also a big believer that you need to convert your active income to passive income.
Okay.
Now, how do you do that? Is by basically no matter how much money you make, if you make $50,000 a year or you make $5 million a year, if you don't invest it wisely in buying investments, I mean, these investments could be property, it could be shares.
We're here today with Mr. Farid Zaki. Farid,
How are you? Thank you.
Good to see you, and thank you for joining us with this. Look, it's an interview, it's a podcast, it's a chat, and we've known each other for a little while now, quite a long time now.
That's right.
And within the networking sphere, within the chambers of commerce. Yourself, you're an accountant, and I think you're a chartered accountant.
That's correct.
ATB.
Oh, yeah.
And I'd like you to tell us a little bit more about the history of that, how long you've been in business, and all of that, just so people, things they don't know about you.
Yeah.
But look, my admiration to Farid has been mostly his strength with networking, his connection points, his smile, and he's very approachable and very knowledgeable in your field. And I don't say it to everyone I meet. There's certain people I think that have done the hard yards. So whether it's 30 years in the industry, I just heard, and following the trends, and the self-managed super fund is a big trend right now. So I want us to talk a little bit about that a little bit, and how that can take advantage of whether it's buying property or otherwise. You know, I don't want to keep it just locked into property.
Yes.
I want us to tell, whoever listens out there, that look, if you want to succeed in structures and start on the right foot for investment or structures or company,
Yes.
I find the first key to all of this is a decent accountant. I've been lucky in the past.
Yes.
That we had a very good accountant who pushed us over to another one later because he didn't tie it. But the idea is, I feel, he saved us legitimately hundreds of thousands of dollars in business.
Yes.
And he was our business accountant, not a personal accountant,
Yes.
because he knew how to structure things correctly,
That's correct.
legitimately in a proper way.
That's right.
So Farid, thank you for joining us. And I would like to just start off with a little bit about you and your background, ATB.
Yes.
Yep.
Thank you, Roy. Thank you firstly for inviting me to come here. It's a great honor and pleasure to be here. So my name is Farid Zaki. I'm a business ATB accountant and taxation professionals. And I've been an accountant for 30 years, in my own practice around 28 years.
Beautiful.
My office is currently based in the Norwest Business Park.
Norwest? Yep.
But I do networking, as you said, in Parramatta,
Everywhere.
Liverpool,
Everywhere. Hills, Parramatta, 3 or 4, Arab Business Council. People see us everywhere.
Better Business Council, the city.
And it's no secret.
That's right.
You're the selfie king.
Thank you. Yes, I enjoy taking selfies and connecting
Beautiful.
people.
Yeah.
And like you said, I mean, the history of where I'm coming from is obviously you acquired knowledge throughout the year. But I'm very passionate about what I do.
Yes.
I'm very passionate about business. I'm very passionate about helping people in business.
Yes.
And in general, like whenever we talk about business, we firstly talk about structure.
Yes.
Structuring is very important. It's just like you're building a building.
Yeah.
If you're building a 5-story
The foundation has
the foundation has to be the right. If you're doing a tower that's 30 stories up, you need to do a different foundation. So that's why we always say structuring is the basic.
Yes.
You need to start about building and working. Where is that? And whenever we talk about structuring, there's 2 things we always look at. So firstly, we talk about tax planning and how you're actually doing the best tax structure. But also we talk about asset protection.
Yeah.
Because obviously the biggest thing is not only about saving tax, but also having protected.
To protect your assets.
Protect your assets. Because at the end of the day, the idea is something could go wrong in business and you get sued. And if you're not protected, you lose all your assets. So asset protection is very important.
Inevitably through the structure, insurance, all of that.
Correct.
Yeah.
So obviously you do it through insurances as the basic, but then you also have the right structure.
Is the common question is protected from what?
Yes. So look, obviously you can protect it from being sued if you are in an industry where you're a high
If you run a business,
and then the customer sue you because you don't do under.
if you're a professional of some sort. So if you are just PAYG, you work for someone.
So obviously, if you're working for someone, that you don't get sued because the entity that you work under, the company, is the one that gets sued.
Yeah.
So, but usually when you're a PAYG, you usually don't have a structure. You're just an employee of a company.
And this family setup, so we can distribute wealth, and then that's probably a high caliber of chat.
Yes.
But just to sort of backtrack a little bit, just on the foundation part, because I feel like all things start with a strong foundation.
Correct.
And back about the personality that the person we're talking to, I think for you, it's you love giving back.
Yes.
And I see it in you when you're helping people start into the networking or meeting new people, and you feel forever connecting people with the right people. So you're saying, hey, you do whatever, you should chat to this person because this person can help you grow.
Correct.
And I think that nature in us, because I share some of it. I don't do it as well as you do, but I share some of it in the sense that I like to put the right people together, because that framework or that team can really accelerate your wealth journey or your success in your business and all of that. And we see that from networking.
Correct. Yeah. So look, I always believe any client or any customer, imagine the customer right in the middle, and we as different professionals are around that.
I love that.
We collaborate together. We talk to each other
At their free will.
At the obviously the client needs to agree.
Yeah. Not just suffocate. I'm just saying. Yeah.
But then that's where the client comes in and say, look, I want a property specialist like yourself, for example.
Thank you. Yeah.
Okay. They want an accountant. They want a mortgage
To pick up the
broker.
phone and I have someone that.
So then they might ask a question and you might give an answer, but they're not really sure what you're saying.
Yeah.
Because they're not a specialist in the property.
Yeah.
So then what they will do, they might ask another person in that circle, whether it be the accountant or the mortgage broker, when they look, Roy said to me, blah, 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 what do you think? So obviously the idea is we can always go back and say, look, explain it a little bit more. Obviously, when the client hears it a couple of times, they say, well, this must be a genuine thing.
Yes.
And obviously, we have to have the best interest for the client.
Absolutely.
At the end of the day.
And it's a client for life.
Okay.
People don't change accountants often. Usually they're loyal with.
We're doing the right thing with people. People will stick with us. And I'm a big believer in collaboration.
Yes.
I don't believe there's such thing as competition.
Yes.
Because there's plenty of even on there.
But I guess,
I collaborate with I have a lot of friends.
The others good at.
And we help each other, we support each other. So again, from our power team, anybody talking about investments, talking about money. So you've got, the accountant, you've got the property specialist like yourself, mortgage broker, financial planner, all of those people, the solicitors, obviously, because they are looking at contracts and doing that. But we complement and complete each other's work.
Perfect, absolutely.
And it's like really having a board of directors helping you on your wealth.
That's your own company, your own board.
Yeah, that's right. Because at the end of the day, I always say it's about wealth creation, but it's also about wealth preservation.
Preservation. I like that.
To create,
Okay.
But also you need
How do you preserve it? How do you keep it?
So preserve it by having obviously insurances and things like that, but having the right structure as well.
And the right team around you. That's very, very important.
And obviously, when we talk about property, it depends what is it that you want with the property. So if you want to buy and just sit on it as an investment and rent it out, it's different scenario. If you want to buy it and you want to fix it a little bit and sell it, it's different if you want to buy it, knock it down and
because of the capital gains issues.
There's capital gains. If it is a property where you're actually developing, it doesn't even fall under capital gains. It comes under normal revenue account, which means it's a business. Literally a business. If you're holding it outside super is a different scenario that if you hold it inside the super. And the tax treatments of that is
and how close you are to retirement.
Correct.
And all
how far are you from retirement?
I feel like it's a very complicated space. And someone like me, I usually would trust in someone like your good self and just say, look, do the right thing by me. You've got to take some drive and you got to know what you're doing. But I feel like you guys as an accountant and keeping up with the latest rules and you sort of specialize in that, of course, the most.
Yes.
Now, let's start from the very beginning.
Yes.
So a client that just started working,
Yes.
like for example, I've got a nephew. He said, I need an accountant. I said, look, you need just this, straightforward account. He's doing a tax return right now.
Yes. Yes.
There's no cars, there's no property, whatever.
Yes.
So it starts there.
That's right.
But I think as soon as you start wanting to explore investments, create wealth, one way or another, and I'm not saying property is the only way,
Yes.
then I feel like they need to see a high caliber accountant. Not to sort of put grades to people,
Yes.
but a high caliber accountant that can start the structure right.
Yes.
So whether it's buying into a trust, and I want to touch that a little bit, the trust structures, family trust, and then possibly self-managed super fund that works for some people, not all people.
Yes.
But day one, I want to start.
Yes.
How would you treat that?
Look, I think the most important thing, and you spoke about that, there is two things that accountants and tax agents can do. Obviously, we do the compliance part, which is the number crunching, doing the tax returns, doing your financial statements, doing all of that.
Almost you can do all this.
All of. But the second one is about the strategy. The strategy is where basically I'm also a big believer that you need to convert your active income to passive income.
Okay.
Now, how do you do that? Is by basically no matter how much money you make, if you make $50,000 a year or you make $5 million a year, if you don't invest it wisely in buying investments, I mean, these investments could be property, it could be shares, it could be whatever sort of investments. Yeah. Even when we're talking property, you could be diversifying between commercial, residential, you could be diversifying in different states.
House,
and all of that.
whatever, different sites.
I think what is important is they need to have advice, firstly, to talk about structuring, but also about where is it that they want to go. So imagine we're going somewhere we haven't been before. What's the first thing we do? We jump onto a map somehow, figure out how to get there.
Yeah.
And that's the whole idea.
Yeah.
If I want to retire after 20 years, after 30 years,
Yeah.
and I want to retire with that,
How will I navigate my way?
how do I get there?
Yeah.
And that's where the idea is you have a plan.
Yeah.
And the steps of how you get there. Through that plan, obviously through that time, you have different journeys in your life. You might start as a single person, then you get married, then you have children. You might be in a situation where when you have children, for example, you need to stay with them more. So you might have two couples, but only one earning more than the other. So you've got to navigate all of that. So there will be periods where you need to say, this period, it's about knocking down my loan as fast as possible.
Okay.
The next period, it might be about building that wealth, using the equity.
Yeah.
But the idea is no matter where you are in that journey, it's about doing the best that you can do
For that years of
what you have at that time.
Would you call it, say, chunks of time, like 5 years? Some people it's 3 years
Yes.
or 2 years, but chunks of periods of time. Because I feel like I'm relating it back now to a timeline of everyone's life, because I feel like maybe 80-90% of us fall into the same thing.
Yeah.
Because as you're saying that, I'm like, yeah, that's, me and 7 clients, it's the same situation.
That's correct, yeah.
But I guess the key out of all of this is leverage.
That's correct.
How do you leverage what you're doing today to get the fruits out of that tree, in the future? So planting the seed and prospering later. But I very much agree. Like for me, for example, when I first started, the first, I would say up to 7 years of owning that property, all I focused on was smashing that loan.
Yes.
I wanted to reduce that loan. I wanted it to zero.
Yes.
The typical Australian dream is to have your property and pay it off and you're good. Some will have the aspiration to buy multiple properties.
Yes.
Some will not.
Yes.
But the first step, and I don't want to get too complex now with rent investing versus buying your first home and whatnot, but there's so many ways.
That's correct. Yeah.
And to be tax effective, you're going to have the clarity and the structure.
Correct. And what you need to do is work out what is actually more important at the stage that you're in. Like you mentioned a little bit, when you're starting up, obviously you have more things to pay than you can afford. So then you might focus about the income that you're generating. That income I'm going to be paying some into my mortgage, paying all my expenses. If you have kids, obviously you're going to have school budgets. You're going to have a lot of expenses to pay first. So you might not have as much gap. So maybe at that time,
and that's normal.
That's fine.
That's a stage in your life.
That's a stage in your life. You got to understand that a lot of times, you can't have everything that quickly. And
So day one,
yes,
18, 19, 20, 21,
Yeah.
because this is, some people will be, this is back then, but this could be for my kids,
Yeah.
because the common genre now out there is like, my kids will never afford property.
yeah,
Well, if you strategize, if you,
yes,
stretch yourself or themselves, there is always a way. But I think the structure and the clarity
yes.
and then chunks of time that you refer to.
And I think also what is important, Roy, is that we need to invest everything and make every dollar that we earn
Love that.
work hard for us.
Love that.
Because it doesn't matter. Like I said to you, you could be earning little money or big money. If you're not using that money wisely and you're not putting a percentage of whatever you're earning
Yeah.
into investments,
Yeah.
that you will never get.
And that's the power of leverage.
So, and this is why it's important that people say, I will never get into a property. Okay, what property are you looking at? Are you looking at a $5 million property? Okay, well, maybe you can't jump in a $5 million property straight away. But what if you start with a $500,000 property?
Absolutely.
And then build yourself that way?
Use it as a vehicle to get you.
It's exactly like you're getting your foot in the door, as they say. But you can't sit back and say, look, I will never get there. Because if you're looking so high, obviously you'll never get there.
Never going to get.
You need to
You're not going to find the castle.
You need
first.
to be in the
Yeah.
market. You need to be in the market to actually have it accelerated.
Yeah.
And obviously diversification is very important.
Yes.
Whether it be property against other assets, or even within property, looking at different
Commercial,
commercial.
high yielding, low yielding, had a capital growth, and we could dwell into that.
Yes.
High yielding property versus high capital growth properties, a bit of a mix in between, and we're not going to go into the detail of all of these because each to their own,
Yeah.
And maybe property is not your thing at all. Forget about this. Maybe you want to do something else. Me personally, I don't agree with many other investments, although there's worthy ones out there, including owning your own business. Some people will testify to that.
That's right. And that's a type of asset as well.
Absolutely.
It's really important if we are talking
Investing back into your own.
if we are talking, and some of our audience are business owners, the thing is, as business owners, a lot of times we put all our eggs in just the business. Now, the thing is, if you've been in the business for 30, 40, 50 years, and you step out of the business, you'll be lucky if you can sell it and get good money for it.
Yeah.
But imagine if you step out of the business and you can't sell it, for example, or it has no value. And that's why it's important that while you are building that business, put money into super, for example, buy property, because the idea is that as nice as it is to be in that transition, 40, 50,
There's growth.
you need to be able the day you step out of your business. If you can't do
Or something else.
you have other assets.
Or about forbid that fails.
Yes, yeah.
And an exit strategy, I think we failed to remember that.
Yeah.
So when owning a business, it's all you, the passwords to everything.
Yes.
You do everything, or
Correct.
maybe a couple of staff, or maybe 100 staff.
Yes.
But what's your exit strategy?
Correct.
What's your continuation for the next person?
Correct.
You can go into a little bit more with, having policy and procedures. That's a little bit more of a business talk, a processes for your business.
Yes.
And I won't claim to be an expert at that, even with my own business, because I'm constantly working on that.
We all
But what I do know though is that you are your business.
correct.
And I think that's our strength.
Yeah.
Because when someone contacts ATB, they're going to get Farid.
That's right.
They're not going to get, with all respect, a junior or someone overseas. It's going to get Farid. Farid's going to do. You might pass on some of the simple work to someone else.
That's
right. The majority of the communication and the teaching and
that's right.
the guiding
Yes.
will be through yourself.
That's
Now, if we go to the next level a little bit,
yes.
so someone that either they have started or have started and got stuck.
Yes.
And I want to talk about a little bit of the structures.
Yes.
Let's go up a little bit. So medium to higher income earners,
Yes.
or people that have some equity or some property,
Yes.
and now they're a little bit. So now it's like, now what?
Yes.
Do I scale back? Do I sell? Do I retire? Do I need more? I don't even know. Do I need more? Some people just do it because it's just the chase.
Yes.
I need just one more property.
That's it. Yeah.
Let's go.
Yeah.
Do you even need it? You know what I mean?
Yeah.
And some will be like, oh no, I've got enough. But dude, if it's just one paid off property, like hypothetically, and with all respect, you can't eat the bricks of it. You know, like you need a passive income, as you referred to before. So leveraging to get into that passive income, which is the golden apple, if you want. It's a golden dream to have a passive income where I can retire and all of that. So if you are around there now, you know, because we spoke about whatever, and I don't want to keep talking about budgeting and all of that. So around there, I find that there's a good chunk of Australians middle age that might be in business and might be around about there right now. What can they do structuring wise?
So I think the first thing is you need to look at their private situation as well as investments outside. Because sometimes what happens is they might be in a situation where they want to upgrade their home from a smaller home to a bigger home, for example. So that's something that they need to look at, but also they could be looking at the investments. So obviously there are two different things. So firstly, obviously, if you are going to upgrade, then you're selling and buying somewhere else. Whether you are not doing that, you're using the equity. The idea is that, you know, if you have a $2 million home and you have a mortgage of $1 million, you have a free equity of $1 million. How are you actually using that to the best of it?
And are you?
Yes. So obviously, a lot of people focus on getting their loans down to zero, which is a good thing. But then the idea is that if you do that and you only have your home, like you said, you can't eat the bricks of the home.
That's right.
How can you live on that? And that's the idea why you need to use loans as a tool to buy into property, to buy into investments. And that's what I always say. So with loans, it's use that as a tool to allow you to enter.
And as a good debt, not a bad debt, because there's a lot to be spoken about that.
So good debt obviously is where you are getting the debt for something that is appreciating in value. A bad debt, like you mentioned, is something that you are getting a debt for something that's actually going backwards. Sometimes we need bad debt. Like you borrow some money, for example, if you got one of your kids getting married and you need this as a necessary thing to do that. It's like, I don't want to, but I have to. Or if you need a family holiday and you're like, okay,
look, I'm at a stage of I work for them things now. You know, I work for the family holidays. I really enjoy this.
Do a little bit of that as well. But also it's very important to use some of that to build your wealth. And that's where it's really important to then talk about structuring. What is it that you want out of that? So if you're a high income earner and you want to buy property, what's your strategy? Is it that it's going to be negatively geared? Do you want to reduce your taxes of that? Because that determines for us the structure. So obviously, if you need the negative gearing to help you with your tax and it's going to be negative, it could be positive cash flow, but after depreciation, it might be negative. If you need that to reduce your tax, you might have to put the property in.
So that lasts 30 seconds to a minute.
Yes.
Is foreign language to most people.
Yes.
And dealing with a professional.
Yes.
Can explain that and really bring it down.
That's right.
But I think most people, that last, let's just rewind it back. So that 30 seconds or a minute of what's...
So let me explain that to you. So what's the difference between positive gearing and negative gearing?
A little bit on that.
So we'll talk about that. So obviously, as you got a property and it's generating you rent, that's considered as income. And then you have all the associated expenses, whether it be council rate, water rate. If you have a loan, you have the interest on the loan. The difference between the rent and those expenses, if it is negative, so therefore you're spending more money, costing you from your pocket more than you're actually generating in rent, that generates for you a loss. That loss can then be offset against any other income. So if you're in a job, you can offset against your job. And you get...
So that's a good thing. If you're a high income earner, you need to lower your tax bracket.
That's correct. So what happens is you basically claim and reduce the tax based on your tax bracket. So if you have high income, you will get more for that loss that you've... So imagine you got a property and you got rent of $50,000 and holding costs of $70,000. So you lost $20,000. Now, obviously, if you're earning $200,000, the tax bracket on that will be higher than somebody earning $100,000.
I get you.
So they will get more for that 20,000 back as a refund because it's reduced their income and it reduced their overall taxable income and reduced their overall tax.
And that part of that could be tax depreciation as well.
Correct.
So whilst it's called negative gearing, it's actually a good thing for you.
Yeah.
I won't say it's a positive.
Look, negative gearing is
Not confuse
a tax strategy.
It's a tax strategy.
It's also important that
It's a legal tax
a legal tax strategy.
And Australia allows it in the tax laws.
Correct.
And they talked about stopping that.
Yeah.
I don't think will ever happen
Yeah.
because too many people rely on that
That's right.
for tax minimization.
Correct. Yeah. But what is also important, Roy, and I do want to stress on this,
Yes.
is that with negative gearing, you've got to actually have the capital appreciation on the profit. So I always say to people, don't get focused on only the tax side of things.
So the property has to still increase in value.
Because
Otherwise, it's a negative.
Correct. So think about it. In that example that we said you lost 20,000 a year, imagine you're in the highest tax bracket and you got out of that 20,000, your marginal rate, assume that's 49 cents in a dollar. So you got half of that back, but you still lost 10.
So you don't win. Okay, so the reason we are making it here is to have capital appreciation of the asset that you're gearing from.
Correct.
Would that be right?
So what I'm saying is that with negative gearing and tax savings, imagine that as the anesthetic that you have to numb the pain while you're holding the property like that. So I actually say that this is why it's important that you need to think about it as a tax strategy.
Yeah.
But the property needs to increase in value because if it doesn't increase in value, and imagine with that example that we said the property is losing 10,000 a year, in 10 years' time, you've lost $100,000. If the property hasn't increased,
What have you done?
then you haven't done it.
So you typically want that property to increase more than what it's costing you.
Correct.
Minimum.
Correct.
And more than that.
Correct.
Now, historically speaking, if this is a typical house,
Yeah.
and negative gearing has been more towards house rather than apartment. A lot of apartments, even in Sydney, where we used to sit on a rental yield of 3-4%. I'm seeing 5-6% on a unit now.
Yes, yes.
And houses are still around the 4%.
Yes.
Sometimes 3, sometimes up to 5.
Yes.
But 4 would be the good medium.
Yes.
So, with the current interest rate, you're still in negative territory. Now, typically, again, and this is generally speaking, the houses have been increasing in value, which means it's, you're going to be in a positive situation. And typically, they grow in value 5-10%, up to 15% per annum. So your capital appreciation is a lot greater than the negative gearing and that's a success. That's a textbook success.
Yeah, that's right.
Now, positive cash flow is something some people will only swear by that. I only want a positive cash flow. This is how it works, blah, blah. Now, if you're a medium to low to medium income earner, maybe it's a strategy.
Yes.
People don't forget that positive cash flow, one property is not going to make you rich. You're going to have a series of these. Because what's it going to give you? $50, $100, $300 extra? Is that enough? And then what's the offset? Is it growing in value or not?
Yes.
So positive cash flow, although it's got a positive quotation around it, and will be.
And that's part of the strategy, right?
Yeah.
Because sometimes with positive cash flow, it could be a person where they can't afford to pay extra money to service the property.
Yeah.
So on that stage of life or the person's situation, maybe that person is better off with a cash flow positive property because they can't afford to pay anything.
Or if they have too much negative and they need to offset it with a positive cash flow, so they pay each other off.
Correct.
Would that be right?
Or they basically don't have the money to pay.
Yeah.
So then their focus is to be cash flow.
Positive.
But then you need to think that everything, the risk, the higher the risk, the higher the return.
That's right.
Which is a non-theory.
Yeah.
And that's the fact of life. So you need to consider both of them. And that's where strategy comes in, because you need to sit and decide what is the plan that you want to do. Where am I now? Where do I want to go? And how do we get there?
And all that depends on your personal income, expenses, how you live your life.
Correct.
So you really need a personalized approach.
That's right.
Gone are the theories where do 1, 2, 3 and you'll get rich. It doesn't work.
No.
Each person runs look, we shadow us each other a little bit, but not completely.
Yeah, it's good to learn from. There's nothing wrong with
Yeah. But what suits you
doesn't necessarily
suit me and my lifestyle and my experiences or my aspirations to what I want to do and not do may well be different to the next guy.
And you look at different generations, for example, in the older generations, people will get married and have kids straight away.
Yeah.
These days, people will finish their work. They will go on, a trip all over the world for 2-3 years. Then they come and work for a few years. Then they get married. Then they have kids later. So obviously, the planning is a bit different. So you need to think where, and that's why it's important to see where you are now, where do you want to get, and have a bit of strategy.
Yeah, there's no right or wrong.
No,
That's right. So it just depends on you.
Yeah.
Now, another thing that's quite common now, and I like the audience to sort of learn a little bit more about that.
Yes.
And mind you, it's not a new strategy. It's not a new thing.
Yeah.
I remember us, and again, it shows a little bit of our age, but 15, 20 years ago, we used to do workshops and seminars about buy property through self-managed super fund.
Yes. Yeah.
Now, before it was a foreign language, like, why do I care about my super?
Yeah.
As you get older, I think, and we're an aging population,
Yeah.
we think about super a little bit more.
Correct.
Some are trying to use that to get into property.
Yeah.
And I think that process sometimes is very daunting. The minute the light bulb switches on or you use the right person, it's like, dude, of course, it's my money. I'm not using it. Let's go.
Yeah.
So just a little bit on that point
Yes.
and what you can and can't do,
Sure.
what you should and shouldn't do, because
Correct.
it's not a free pass.
Yeah.
It's not money that you put in your savings and you go,
Yes.
to Athens with.
That's true.
It's
You've got to do it the right way.
yeah.
I guess before I start, what we should do, and probably we should have done that at the beginning, is put a disclaimer.
Let's do that. Rewind.
Rewind. Yes. Make sure that obviously whatever we talk about is for general information.
Absolutely.
Speak to your accountant, speak to your
Please,
financial. Make sure that you speak to the right people, because your situation might be different.
And I think we've said that throughout.
Yes,
Look, on a serious note, because I'm big on that too.
Yes.
It's not to listen to this and go,
But
but it said that, or I said that. No, like each, I keep saying it, each to their own.
Correct.
And you may not want to do any of this.
Yes,
You know?
that's correct. So I'll just run a very quick scenario from the beginning today.
Yes, please.
A client walks in through the door and say, I want to buy a property through an SMSF. What's the process?
Yes.
So usually the process is they need to start with going to a financial planner
Yes.
to take a fact find and find out and do an investment strategy for them.
Yep.
Make sure that it sits right with where they want to go
Yeah.
and how they want to go doing it. The financial planner will then issue what we call a statement of advice.
Yeah.
They will then direct somebody like myself to set up the self-managed superannuation fund. Self-managed superannuation fund is a type of trust. We set up a trustee, a company trustee with it. The reason that we do that is the trustee is the entity that gets sued. So we want to make sure that they are not personal names. And also in case where you have, say, two people in the self-managed superannuation fund and one of them passes away, if you've got a corporate trustee, the SMSF can continue.
Yes.
But if you've got individual trustees, you've got to undo the whole thing. So it's important to
And you can still have up to 4 family members.
That's correct. So you can have 4 people in. They don't have to be family members, but as long as none of them are actually employees of others.
Oh, okay.
So you can't be the boss and have your employee with you in the SMSF.
Yeah. What if you employ your son?
Well, technically, he's
not saying more than he is, Mark.
That's right.
Okay, fair enough.
Yeah, the idea they do it like this is obviously because there's no control element.
No. Yeah. Okay.
But also part of the stretch where you need to look when you're talking about parents and kids in the same SMSF, that's where the financial planner would come in, is you need to consider that the parents will get into retirement much quicker than what the kids will do.
Of course.
So if you have a property in there, what are you going to do? Are you going to sell the property? So it's also a very important part of the strategy to look at that.
Yeah.
I know a lot of people like to say that, parents and kids doing it,
Yeah,
but if there's a huge gap in age, you need to consider that.
Yeah.
Obviously, that's something you need to speak to the financial planner. But going back, so we set up the SMSF, and then the financial planner rolls over the money from your current superannuation.
And sometimes they're still scattered. As I remember when I did mine, they were scattered. There wasn't a lot of money, but it was scattered.
Yes.
And then you bring them down.
Bring it in there.
And any time you've worked, any time you've paid the super, you collect that. So it's good audited
into the
and it goes into the SMS.
Yeah. And then you have a mortgage broker. The mortgage broker then decides or finds out for you how much money you can borrow. Obviously, once you get it up on top of what you have already in the fund. And then you go to a property specialist like yourself, where you find the property and then they buy the property.
That matches them.
Before they buy the property, we need to create what we call a bear trust. And what it means that the whole idea of that bear trust, it is there to hold the relationship between the lender and the SMSF, because the lender is not allowed to touch any of the other assets in the SMSF, only the property.
Yep, says that.
Standalone property and standalone loan. And then they let you.
It's not like grizzly bear. It's bear as in the
That's all it does. All it does is basically holds that relationship.
Yes.
Once the loan is paid off, you then transfer the property across to SMSF without any stamp duty or anything like that. And then what happens is at the end of the financial year, you do your financial statements to work out the rent. The rent plus the contribution is considered as income in the superannuation. And then you have all your rental expenses plus the insurances of the members, as well as all the associated costs, the accounting fees, the external audit fees, and all of that. And then the net figure is then taxed at the superannuation rate, which is 15%.
Much lower.
While you are below pension age, it's taxed at 15%. Now, this is where the superannuation environment provides very good, lucrative tax benefits because it's taxed at 15%. If you buy and sell the property after a while and you have capital gains tax, you only pay 10% tax.
Which is much less than outside.
Much less than when it's on your tax bracket.
Yeah.
After pension, you pay zero tax on the income and you pay zero tax on capital gains.
Okay.
So obviously that's a very good environment to be in with self-managed superannuation.
So from day
The
one,
only catch, let me just put that point, sorry for that cutting you, is the property that you buy, if it is a residential, you can't live in it.
Yes.
Nobody related to you by blood or marriage can live in it, even if they pay rent, unless it's a commercial property.
Okay.
So if it's a commercial property, you can rent it from yourself as long as you are paying.
So the business can,
You have a business premises, you can own it in the SMSF and pay rent to the SMSF.
I know European surgeons usually do that.
That was right. Yeah. But if it is a residential, you can't live in it. Nobody related to you by blood or marriage can live in it. And the other thing which is very important is that if you have a property and the property makes over time, you pay off the loan and it has equity, you can't use that equity as a collateral to buy another property. So every property has to stand on its own. You can save money in the SMSF, enough money for a deposit and go for another property by creating another bear trust. So the SMSF stays as the main vehicle, and then every property that you hold with a loan, you create a different bear trust for it. So that's the only two differences with properties inside the super
versus outside.
Outside the super. If it's residential, you can't live in it. Anybody related to you by blood or marriage. And the second thing is the equity that you make. You can't use that as a collateral or another property.
Has to stay there and
that's correct.
So it sounds like it's a very good environment because the tax bracket is less and all of that. I think, and of course it comes with restrictions to what you can and can't.
Yeah.
And also for the viewers, property is not the only thing you can buy with South. You can buy other
shares, investments, stocks.
And then you'll start thinking, oh, well, maybe I should pay more super.
That's right.
And there's a super contribution that depends on your situation. There's limits and all of that. I don't want to get into the details of that.
And put more contributions in it. I think also another advantage of doing this, Roy, is that you have the element of gearing.
Yes.
Because if you have $300,000 in the super and you can borrow another $300,000, all of a sudden you're investing $600.
Yes, absolutely.
So the return on the $600 minus the cost of the $300 loan, hopefully will be better than just the return.
Because usually if you only had the 300, not only, but if you had the 300 and then it was invested in shares, it's the returns on 300, not on the 600.
Correct.
So leverage again.
So that's another thing. Yeah. You've got the leverage and you've got...
Although I think you can leverage a little bit, but not that much. I think the leverage amount on property is much higher.
Yeah.
Now, then says to think, why is all of this allowed? Like, it sounds a bit, like you shouldn't be doing this. Like, why do you have that?
Look, the main rule that you need to understand with self-managed superannuation, it's an investment for retirement.
Yes.
So all the restrictions around self-managed superannuation environment is just to make sure that whatever you do, It's money preserved
Yeah.
for when you reach retirement.
Yeah.
And that's why you're not allowed to run a business out of an SMSF.
Yeah.
Because business is obviously high risk.
High risk.
You can't buy a property, knock down and
So it's
build
pretty
it
much
to
a
an
forced
SMSF.
investment. It's a forced saving.
It's a future.
It's for the
If you think
future.
about it for the
Because
future.
I think, some of us do this and do this very well, and some of us don't do it at all. But I think the Australian government or the taxation office allowing you to do this
Yes.
is pretty much saying to the average guy out there, go out there and set up your own future.
Yes.
Do not rely on the age pension or, on Centrelink
Yes.
or whatever it's called right now to go out there and live, because it's not going to be enough for you.
Yes.
So work on yourself.
Yes.
And I'm not saying to be a zillionaire by the age of whatever. It's not about that. It's about have some sort of a strategy. So when you do retire,
Yes.
you're not burdening society.
You're comfortable.
And you're comfortable and you can do the things that you want to do and rely on yourself. So I think
Correct.
that whole environment of Money Super Fund is perfect for that. Now, some of us will know exactly what's in super.
Yes.
Some of us will have no idea
Yeah.
what my super amount is.
Yeah.
But I think people are more aware of it now because they're hearing it more out there.
Yes.
So, and from strategist perspective,
Yes.
so if someone just started, 16-year-old, it doesn't make sense to have a self-managed super fund, I don't think.
Yes.
There's a certain quota, I feel, that because there's expenses. So you've got to do your auditing with self-managed super fund,
Pay the accounting.
pay the accounting fees and all of that.
financial plan.
So what's a good amount? Not a perfect amount, but what's a good amount to say, hey, I've got that much, I should do a self-managed super fund.
Yes.
What because it's going to equate to the fees within
Yeah.
AMP, whoever you're with,
Yeah.
or self-managed super fund.
That's actually a very good question. A lot of people ask that question. The law doesn't actually have a figure.
No, I know the law does it, but what makes sense?
But the idea is it comes back to what is it that you want to do? Because think about it this way. Obviously, like you said, there is holding costs. If, say, the average holding cost of an SMSF is $5,000-$6,000, for example,
Per annum.
per annum, compared to outside when you have it with a retail fund, it's a percentage.
Yeah.
You need to compare that return.
Yes.
But also you need to compare with the money that you have, how much money you can borrow.
The land real also
And the
opportunity.
whole lot
Yeah.
will give you what property, number
Yes.
one. Number two, obviously, you don't want to be only invested in property and have zero money in the bank. You need to have enough money to service.
In case there's no rent.
You need to have diversification. So you need to have some shares. You need to have some money in the bank to pay your expenses.
And this is how you should do it outside of super anyway.
So that's why it's important that when you actually sit down is you work out what is it that I have. So is it that I need $300,000 in my super to start off, or is it do I need 500? So there is no magic figure, but it's about what do you want to do and what is your contribution strategy? Because that's the thing. How much money are you making? How much super is being pushed into the SMSF? Because the idea is maybe you have a small super balance,
Yeah.
but you say, you know what, over the next
I'm going to
few years, I'm push a lot into it. There's also a strategy where you're allowed to go 5 years back. And if you haven't contributed the maximum, you can contribute that.
Yeah.
So that's why it's important to talk to your accountant plus your financial planner
Yeah.
to work out what is the strategy.
Yeah.
Because if you are on a very high income and you want to push a lot of into the super and get the tax deduction,
Yeah.
as long as you're allowed to, you can go backward 5 years and allowed to have that as a reduction and build your super and then get into the investments quicker, then it's a worthwhile exercise. But it's really important that you sit down and do the number crunch.
Yeah.
What is it that you want to do? And that will give you the magic answer. Because everybody is different,
Yeah.
and there isn't.
I hear you, and I love that because it all depends.
That's where it all depends. Yeah.
And I think it's a mentality shift where it becomes, it's in the name, self-managed. My super.
Yeah.
So, which means to me that I controlling my own super, my own destiny, and that I may work harder towards it.
Yeah.
Some people are talking out there about using their super to purchase their first home. Is there a touch point on that, or is it unclear, or is there enough information about that?
So this has nothing to do with self-managed superannuation, but this is the government allowed people to withdraw a certain portion of their super to fund buying their first home buy. But there's certain rules and regulations. How quickly do they need to use the money? How much money can they withdraw into the super? So there's a lot of rules and regulations. If you want to do a podcast on this on its own,
I
probably would, because there's a lot of detailed information.
I do feel like it's
But that's out of
whole other world.
superannuation.
Yeah.
Self-managed superannuation.
I think we touched a little bit on sort of growth and strategy
Yes.
and networking and so forth. And I think the one of the main giveaways for me is that with better structuring, you can fast track, you can get things done better. Now, just one little thing, because we mentioned financial planner once.
Yes.
If I need to create a self-managed super fund, do I need to see a financial planner or can I see an accountant?
Okay.
Or both?
Okay. So technically speaking, a self-managed superannuation
Yeah.
is considered as a financial product.
Yeah.
Because it's a financial product, it needs to get advice from a financial planner.
Yeah.
Okay. As an accountant, unless I have a financial planning license,
Yeah.
I'm not allowed to give advice
Advice.
on it. And that's why it's important to speak to a financial planner.
Yes.
Another benefit of having the financial planner is the financial planner works out if this is a good strategy for you. But also what is important, the financial planner does a lot of other work behind the scene, which we don't realize. And I'll give you an example. While you have, say, your superannuation outside the self-managed superannuation fund, you might have inbuilt superannuation products in it. Okay? The minute you move all your money across to the self-managed superannuation fund and close that fund, all these insurances go.
So you need...
So what the financial planner does is they look at those insurances and say, can I move these insurances across to the SMSF? Or if you are in a good health and you are insurable, they can close those ones and set up new ones for you.
So that
It's also very important that sometimes they move the insurance across. Because sometimes you might have had the insurance when you were healthy, you don't have any health complications, but then all of a sudden you have illnesses that are not allow you to be insured. If you close those funds and try to open new ones, you won't be able to do it.
Yeah.
So that's a job that the financial planner will need to do.
Yeah.
Now, that's just one example. But also the financial planner basically sits down with you and map that strategy.
Yeah.
With SMSF, because it's a financial product, you need to have financial knowledge on it. And the financial planner also talks to you about diversification and talks to you about, even if you're looking at property, what is it that you want to do? So obviously somebody buying a property as a commercial property to rent it from themselves, different strategy than they do it for investment. They're doing residential, commercial. So based on what they want to do, they figure all of that. And that's where the power of that collaboration team that I was talking about, where you have the accountant, the financial planner, the product.
And all respect to that.
That's right.
Yeah.
The mortgage broker, the lawyer, that we're talking all.
You're as good as your network.
That's correct. That's
look, it seems complex on the outside.
Yes.
But there's a in an easy way of putting it, if you don't know something, ask someone that knows.
Correct.
So seek the advice, seek the knowledge. Professionals in the industry that practice what they preach.
That's right.
Not just the genre out there that, do this and become an alpha. It's not about that, It's about genuine understanding and learn it for yourself. There's no harm in doing research and going out there and sort of self-improvement, whether it's financial, whether it's health, whether it's whatever the case may be. I think it's important for self-improvement, and I guess you need the right partners, because I'll go back to something I always said. We were never taught this at high school.
That's right.
Some of our parents taught us a little bit more, some taught us less.
That's right.
Of course, they've taught us fundamentals in life and how to be a good person.
That's
right. But some of our parents weren't into this property space, or they weren't into, professional services.
Or they could have been a band with...
Or had a bad experience. Correct. And
a couple of days ago, I was talking to a person that had a very bad experience, bought a property, the developer did the wrong thing, the whole building is in problems, and she's in distress because of that situation.
And it's a real distress.
So then what happens is, obviously person has a negative.
And then that follows through generations.
That don't follow. That's right. So sometimes it goes wrong, sometimes it goes right. And that's why you need to go to professionals, like yourself. If they're talking to a property person, you need to make sure that the person is actually researching the property for you.
Yeah.
So you're not buying into something.
Had a track record.
That's
know what they're doing.
Yes.
But I really thank you for that information.
Thank you.
Because I think there's a lot of good takeaways.
Yes.
I think we could dissect each thing what we spoke about for another 6 hours.
That's right.
You know, but and then I'll have to pay you.
That's it.
Yeah, thank you.
We keep going.
We'll keep going forever. You see, I think when you have a passion for something,
Yeah.
you just comes out naturally and it just flows. I think we don't have a piece of paper in front of us. It just these are things that we live and breathe.
That's right.
These are things that we really enjoy serving people with.
Yeah.
And I guess if there's anyone that wants more information about this, wants to reach out, wants to connect with the right people,
Yes.
I personally vouch for Farid and the team at ATB that they can sort you out and help you with your strategy from start to finish. A real genuine service is how I feel. So, and hopefully there'll be more of these.
Yes, definitely.
I think now we got the flow.
And if people have questions, they can reach out.
They'll reach out. And this will be on social media, so maybe on social media or directly to your website.
Yes.
And go from there.
Yeah.
But I know you're easily found.
That's right. Yes.
You'll find him in a selfie somewhere.
That's it. Yes. And obviously, that's the power of networking, collaborating with the different partners. Absolutely different things. Yeah.
Absolutely. And we do encourage that.
Yeah.
Anyone that's starting in business, anyone that wants to exceed in business and be seen, even if you work somewhere and you go to these networking events, guess what? You might find other opportunities out there and stand out in your workplace, even if you're working somewhere. Where you're self-employed, you want to go out there and do this. I think we could talk more about the networking and sort of business. It's not my specialty, although I fell into it and you know,
And you're very good.
thank you so much. But I enjoy it.
Yeah.
And maybe we'll talk about that at a different interview.
Yeah.
But thank you for your time, Farid.
Thank you. Appreciate it. Thank you very much. Thank you.